Also to be part of something that's so important. The Be India team has done an amazing job in providing the G20 with important input into their deliberations later this year. India is a great nation. You're not only the largest democracy in the world, but you've provided so much to the world, and your leadership is just beginning again and again. And so thank you for hosting us. And my deepest thanks to this amazing panel of both industry and finance to take on this very important question about financing the climate transition. We need to think of it both as an obligation and also as an opportunity. And I think that's what we will flesh out today on this panel. We have to create a vital and effective partnership between the public and private markets if we're going to solve the climate problem. There's no option. The strongest force in the world is the private market, and we need to make it work. And we need to make it work for all of the constituencies. And just briefly, as context, I think we need to define the problem. It's really not just about greenhouse gases. It's not just about 1.5 or 2 degrees Celsius. It's also about how the transition affects people, how it affects the price of energy, how it affects our national security, how it affects workers. And this, I've often felt that the environmental movement missed the people part of it. And I'm very grateful to the two gentlemen on either side of me, Bernard Looney and Mark Carney, because they joined with me the Council for Inclusive Capitalism that was inaugurated by Pope Francis in 2019. And the inspiration from the Pope came from the Laudato Si when he talked about the climate and that we had to listen to the cry of the earth and the cry of the poor. And I think we always have to keep that framing in mind when we think about the problem. We have done work at the Council to create a just energy transition framework, and the conversation needs to be along those lines. We also have to think about the scale of the problem. I mean, we have been on this planet for 300,000 years, and somehow we've just managed to screw it up in the last 60 years. And so it's our obligation to fix it. According to the World Economic Forum, 44% of global economic activity is somehow dependent on nature. And 1.2 billion, or 40% of global jobs, are dependent upon climate. So the scale is enormous. But unfortunately, to fix it is going to cost a lot of money. Bloomberg says it's going to be $200 trillion, or $7 trillion a year. Uday said that it's going to be $4.5 trillion a year through 2030. Unfortunately, from 2011 till 2020, between public and private finance, there's been about $4.8 trillion toward this problem. So we really have to up our game. And the good news is that by doing it, we will be creating opportunities. There's the World Economic Forum says there are 365 million jobs that will be created by transferring our economy to a clean economy, and that'll add $10 trillion a year in economic growth. But there's no better group to delve into how we're going to get it done than this group, which has already been introduced to you. And on that note, I want to turn to Mark Carney with the first question. There's very few people on the planet who we can thank more than Mark Carney for the progress that we've made toward climate change. He's he's too modest to want me to say too much more, but we should all be incredibly grateful to the role that Mark Carney played, both in his role as governor of the Bank of England and before and after that. So, Mark, why don't you frame for us how governments and public finance industry can work better and more effectively with the private sector?
Thank you very much, Lynn. Let me thank our B20 chair, Chandra, and the whole organizing team for this extraordinary event and all the work that's gone into it, the substance behind it, and the impact that this is going to have on the G20. Because as you've just put on the table, and Uday did yesterday with the numbers, and I'd be more on the 7 trillion end of the spectrum. It is absolutely an enormous amount of capital that has to go everywhere. We're not going to solve this problem anywhere unless we solve it everywhere. And I'm going to zero in really on the emerging and developing world and what governments and the multilateral banks need to do to address the developing world. And the first point I want to make is that we've really been caught in a situation where individual institutions have been acting rationally but collectively foolishly. So the major development banks, the World Banks and others have been very carefully managing their capital, good stewards of that capital, and as a consequence of that, feeding the problem. And what needs to happen, and I think the Indian G20 presidency has started this process with the work of N.K. Singh and Larry Summers and others, is to change the orientation of these organizations. And the orientation has to be, what is our contribution to helping to get to that 7 trillion per year number in the emerging and developing world? So it's not how much lending we do as, let's say, the World Bank, but what's the total capital that we're catalyzing with our activities? So the core objective has to be focused in that way. And there's really 3 ways, and I'll just outline them quickly and then hand back, that they can do that. And the first is to use their balance sheets much more effectively, to take on the risk that the private sector can't take on. And that is through mechanisms such as guarantees, it's through subordination, so taking first loss, and it's through recycling the balance sheet. If you make a good loan, if you help to prepare a project, then hand it on to somebody else who can see it to the full conclusion and take that capital back. And this is the work that Ajay Banga and others are involved in at the World Bank. So first, use your balance sheet more effectively. The second is really to focus in on transition finance, and it goes back to the work that you led and Bernard's leading on a just transition. We all understand clean energy, but the biggest challenges are in the hard-to-abate sectors, the existing energy system, the workers and the communities that are affected by those. And we need to get capital to all aspects. And the international institutions cannot just provide some of that capital to help phase out, for example, a thermal coal activity in a responsible period of time, but to help retrain those workers and, very importantly, to allow private capital to come in alongside, because let's face it, there is a reputational risk to have exposure to those. And then the last thing I'd say is that I think the governments and the multilateral institutions through this G20 and at COP28 has to grasp the nettle around some of the key markets, and I'll point to one, which is the market for voluntary carbon offsets, sometimes called carbon credits. In effect, if we do this right, the world does this right, we will have transfers from some of the largest, best capitalized financial institutions and companies in the world to projects in the emerging and developing world, transfers on the orders of magnitude of $150 billion to $200 billion a year if we get this right. Now, that is not a get-out-of-jail card for those companies. Those companies are going to work to get their emissions down, but it does mean that we can catalyze action. My point is that the governments and the international financial institutions can help set the rules and govern those markets so that those transfers really are having the impact on the ground.
Just to follow up, that's such an important point. Do you believe that there can be a voluntary carbon market that is not regulated by governments, or do you challenge governments to regulate?
Well, so what we've had to do is to put in place the standards on what's called supply integrity, so you know that the nature-based solution is happening, or you know that the coal plant is being phased out and the renewable plant's being put in place, and you get that. Those rules have been developed through something called the ICVCM, and John Kerry and others are working in parallel with that. And then you have to determine who can buy those credits. And in effect, the ability to buy those credits is, are you trying to get your own emissions down? And if you're trying to do that, and there are standards that have been developed for that as well. And so what we need now from governments is to say these are the right standards, and then transparency to track both sides of the supply and the demand side, and actually what's being put in place are mechanisms so that all stakeholders can. So we're ready for this to happen. We need the hand of government and authorities to say, okay, we sanction this and move forward.
So we need government for both finance and regulation. So let me turn to Bernard Looney, who you're right in the middle of it, of taking incredibly important actions to move BP beyond petroleum, as you said many, many years ago. But also, you are well aware that the transition needs to be not only rapid, but also orderly. And perhaps you could describe to us from your point of view as an industry leader what that transition looks like.
Well, thank you, Lynn. Let me add my thanks, as Mark did, to Chandra and the team. Superb, fantastic to be here in India. India is the future. If you don't know that, you certainly feel it when you hit the ground. So great to be here in India with you all. And Lynn, thank you for your leadership, because if Mark is to be thanked, so are you. What you've done with the Council for Inclusive Capitalism is extraordinary in bringing us together and bringing about real change. And I just want to personally acknowledge you for what you're doing and continue to do. And it's great to work with you. A rapid and an orderly transition. What does that mean? I think in many ways the case for a rapid transition is relatively straightforward. Emissions have risen every year since Paris, with the exception of the pandemic. And during the pandemic, emissions fell by 5.6% when the world essentially ground to a halt. So that is not a strategy that we wish to employ. But the reality is that emissions are continuing to rise, and therefore, with each day that is happening, the urgency around the pace and the speed of the transition simply grows. So in many ways, the case for the rapid transition is relatively straightforward. The case for the orderly transition, I think, is something that we need to spend a little bit more time talking about. Now, an orderly transition is one where today's energy system needs continued investment. And today's energy system, some people don't like this fact, but it is a fact. It's 55% oil and gas. It was 57% in 2012. And it needs continued investment. Why? We need to make sure that we continue to match supply with demand. Why is this important of today's energy system? It's important because of the following. Last year, the world lost 3% of the world's gas supply. Demand didn't change because nothing was done to change demand, but supply was lost, 3%. Prices went up sevenfold. Not 7%, not 70%, 700%. Now, what happened when gas prices rose sevenfold? Two things happened. The first is that countries, to fuel their economies, turned to the next cheapest alternative, which is what? Coal. Coal usage reached a record. German coal consumption went up 25%. South Korea's coal consumption went up. Japan's coal consumption went up. I think coal consumption went up here the same in China. That's not what we're trying to achieve with the transition. So that's the first thing that happens when we don't match supply and demand. And the second thing that happens is that typically in an OECD economy, between 10 and 12% of the GDP is spent on energy. Last year, that number went to 20%. 20% of GDP being spent on energy. That is not sustainable economically, nor does it leave any room to invest the necessary dollars into the transition. So we need a rapid transition, but we also need to make sure that the transition is orderly, that the transition is just. If it's not just, there won't be a transition. Now, how do we do that? Well, we do that in our language at BP in what we call a very simple strategy description, which is and, not, or. We must invest, like crazy, you would argue, in accelerating the energy transition, period. And, not or, we must at the same time continue to invest responsibly in today's energy system, which is a hydrocarbon system. It is an and strategy, not an or strategy. And we're doing that here in India. We're investing with our great partners, Reliance, in offshore natural gas here. We've just brought on a field recently, and we're now producing, I believe, 1/3 of India's domestic gas production here in India. And, not or, at the same time, we're, through our GeoBP retail network, rolling out EV charging points as fast as we can. Sashi, who runs our business here, told me that when I was here in January, we had 750 charge points. Today, we have 3,000 charge points. We've just completed 300,000 battery swaps for 2- and 3-wheelers. These are not in contradiction. This is an and, not or strategy, because India wants to be net zero by 2070. It also wants to have energy independence by 2047, and it has every right to want both of those things. So, Lynn, that's what we're trying to do. That's why this conversation is so important, because if ever we focus on just one aspect of the equation, I worry that we won't achieve the goal that we all want.
We have to work with the people who are giving us energy and help that transition. It's very important. Verena, I'd like to turn to you, if I may, because you are such an important source of private capital in the renewable industry. So how do you see that working, and what is the future, particularly toward that enormous number that's needed?
Thanks, Lynn, and I'd like to also thank the chair of B20 and the organisers for bringing this panel together. I think Macquarie has had the opportunity to work with some of our fellow panellists and the organisations they represent on climate transition initiatives. So we've actually seen the commitment firsthand, which is really great. So over the last 2 decades, Macquarie has really worked with governments and our clients to really support energy transition initiatives and really try and find practical solutions to climate challenges. We're continuing to leverage really our deep expertise in infrastructure, in energy, in commodities to help companies meet renewable energy targets, to strengthen infrastructure resilience, and also support decarbonisation initiatives. If you look at our client base, many of them are, pension funds, sovereign wealth funds, institutional investors, insurance company, amongst others. But what is common about them is that, I describe them as patient capital. So they do have the ability to look at things long term, which means they should be well suited to invest in transition, which will take longer. And if I look at this space, there has been a real dramatic increase in investments coming into this space from this group. So if you look at it globally, I think there's been more than $90 billion of capital flooding into decarbonisation investment funds over the last 2 years. And so whilst global investments we know need to triple, I think, for the rest of the 2020s, we believe there is no shortage of investor appetite or investor interest in this space. So the question is really converting that interest into something tangible in terms of deployment. So there are many ways I think private capital can accelerate the deployment in this area. But in the interest of time, Lynn, I'll probably just focus on 3 areas. The first one being, I think private capital needs to accelerate its deployment in mature technologies such as solar and wind, to really, this sounds really obvious, but to provide communities with clean and low-cost electricity. So based on our experience in, say, markets like Taiwan and Korea, particularly in the offshore wind space, we've really seen the benefits when governments set clear ambitions through national targets, which are then backed by strong and sustained policy commitments. Now, of course, barriers like permitting challenges or supply chain challenges do remain, but it's really that government commitment that's really vital. Secondly, I would say just investing in mature renewables or technology alone is not enough. So private capital really needs to support its investments or, commercialize emerging technology. And that's going to require a significant amount of capital across infrastructure investments. And based on our initial commitment into this space, we've actually seen it work really well when there is that strong partnership between communities, developers, off-takers, policymakers, and financiers. So we really need to, work out how we do that better. We've also recognized that you do need a different mindset when it comes to scaling in this area. So the one thing that we do, which is a bit more within our control, is work out whether we have the right sources of capital to play in this space, because we do recognize that, even at the investment committee level, looking at the risk return profiles of these investments may not be the way we should be looking at it traditionally. And then finally, I would say we've started to see more carbon-intensive assets really struggling to secure, affordable insurance. It's obviously really difficult to finance or even refinance. And, when we look at how do we exit these investments, the reality is there is a constraint in terms of future buyers. But what we've also seen is if we, by engaging these existing assets on a net zero pathway, it's given us a bit more clarity on, what the investment future is for these existing assets, and also actually produce secondary product streams and services. So I guess hopefully that's given you a bit of sense of some of the opportunities and challenges we're seeing.
Yeah, I'm interested just in a follow-up on the direction that you are seeing from the asset owners, from the sovereign wealth funds, the pension funds, your investors, toward investment in renewables over the last 3 years. Have you found that there has been a greater reluctance in recent years to fund renewables because the returns have not kept up with many of the non, or do you still have investors? And I see Mark Carney wants to get into this question. You know where I'm headed. So where are the asset owners when they get into their investment committees actually on this question?
Yeah.
And I know I'm going to
go
turn to
first,
Mark because he's
Okay,
really
well,
anxious to answer this. No, Verena, you answer first.
Okay, so it's a good question, and I don't think I can speak on behalf of every single sovereign wealth fund or pension fund, so it is a little bit case by case. There are more questions about risk returns on renewable assets because they're obviously, at the end of the day, they're looking at their portfolio and wondering whether the investment actually makes sense. But we are still, I think, the overall interest in this thematic and the buy-in into needing to actually invest is still there. But I have to say, it's jurisdiction by jurisdiction and the type of investments we're making, it does differ a little bit.
I'll give a very quick answer, if I may. Just we see overwhelming interest in this from a Brookfield perspective. We raised a $15 billion transition fund. We closed it 14 months ago. That's entirely deployed. We'll see where the returns are, but they will be very attractive returns. We're back in the market raising again. We have a $80 billion backlog around this, and to go to something that Verena rightly emphasized is where there are huge opportunities here, absolutely huge, and literally huge opportunities in India, as this group knows and is living. But as you rightly emphasized, where there are significant opportunities, if you can go to those places where there's transition, to pick up on something that Bernard was saying earlier, and you're part of the and. So you're moving across, it can be an industrial company, it can be an existing generator that has a mix of generation, and then you're getting in and being part of the solution. So I would say what we're seeing in terms of investment dollars being put out and interest in it is a wall of money. I mean, it is a wall of money. Now, it needs to be a wall of money because we've gone from 500 billion in clean energy investment 7 years ago to 1.2 last year, 1.7 this year, but it needs to go up to 4. So it needs to keep going, and that's the context.
So you see that happening, even though it hasn't happened over the last 10 years. But
No, Lynn, it's gone from 500 billion to 1.7 trillion. That is happening. That is a triple. That is bigger than the investment in conventional energy now. Now, Bernard would say that there needs to be a bit more investment in conventional. At least we need to maintain it in order to keep that there. But now, globally, the investment in clean energy solutions is a bigger market than the investment in conventional energy. So that has happened. I don't recognize at all the idea that it hasn't happened.
4.5 trillion isn't 1.7 trillion, but
4.5 is the number by the end of the decade. 4.5 is the number by the end of the decade, not now. The IEA number right now is 1.5 trillion, is where the run rate should be. The point is, it's where it's got to go, but it's already tripled over the course of the last 7 years.
Okay. So why don't we turn to another industry player, Narendran? You are present in both the global north and the global south, so you're dealing with the enormous end of the problem, which maybe the carbon credit market can help address. But can you tell us how you see the transition working in the global north and the global south from your point of view? You have a hard-to-abate industry indeed.
Yeah, thanks, Lynn. Yeah, steel accounts for 8% of the carbon footprint in the world today, and steel is growing, particularly in emerging markets. I think the transition has started to happen, but it can happen only if, firstly, there's a policy framework to support the transition. There should be carbon markets, which there are in Europe. There is this carbon border adjustment mechanism, which is being debated. There needs to also be infrastructure support because steel depends a lot on coal. Coal is used as a reductant, not just as an energy source. So coal supply chains have been built over 100 years. So we saw, the importance of supply chains even when the recent disruptions happened. Even for gas, the supply chains are only about 40, 50 years old. So transitioning from coal to gas to hydrogen, even from a supply chain point of view, is a very complex challenge. The scale is very significant, so it's not about getting small amounts of gas or hydrogen across. If you want to electrify process industry, you also need to make it easier for electricity to move easily across countries and across continents. So I think the cost and complexity of this journey is going to be significant, and we should not underestimate that. The industry can support part of the cost, but the cash flows of the industry in mature markets cannot underwrite the cost of transition. So you need government support. You also need customers to be willing to pay more for green products. So I think all this needs to converge for the industry to transition and have a sustainable business, not only from an environment point of view, but also from a financial point of view. So it's a long journey. I think the journey is started in Europe and in the US with the IRA. In India also, we've set some very aggressive targets for renewables as part of our grid. But a lot more needs to be done because a lot of the increasing steel capacity in the world is going to come up in India, and we need to transition into a greener process route sooner.
So Uday, as CEO of one of the largest financial institutions and one of the fastest growing economies in the world, dealing with this, how would you feel you're placed to make this investment that Narendran and Bernard and others need to actually solve the problem?
Lynn, I think we are basically dealing with two counter forces. First is a race with reference to the existing and existential viability of planet Earth. And the second is the economic viability of the business model of planet Earth. For existential viability versus economic viability of the business model of the planet Earth. And I think we have to be clear that the risk of existential viability of planet Earth has to be put a step above the business viability of planet Earth. And therefore, while a lot of focus is on transition financing, which I think is important, but do we have the time to play for the economic viability to work out versus the existential viability? And it is here that I think we have certainly no choice to go beyond capital which expects returns to capital which is gap and ready to take the losses. And where is that loss-bearing capital going to come from the planet? It has to come from businesses around the planet which are making economic profits today for existential viability of the planet. And if we look at this equation and prioritize existence over economic viability, there has to be first money from business. And I agree with what Narendran said and what Mark as well said. It has to be a partnership with government. Government has to provide those loss-bearing guarantees in addition to private capital. And therefore, the model which I believe the world needs to move to is gap funding provided by governments and supplemented by some of the current economic profits from business worldwide. And add these two and hand it over to appropriate institutions, including a multilateral institution, to be able to leverage this capital at 7, 8, 10 times. So you create a large enough pool of global capital which can go and fund on a priority businesses on gap. And how do we do that gap funding is going to be critical. We cannot expect private businesses to do the loss-bearing funding for a project unless there is gap capital coming separately. And this is the change which I think we need to make in mindset, and a sense of urgency and paranoia, which currently seems to be that we will transition our way. An existential issue of the planet is going to be after economic viability is protected. I don't think that's the time we have.
Okay, Mark, so you're a global bank doing a lot in Asia. What is your perspective on this conversation about how to turbocharge the private markets to invest in the transition?
Lynn, thank you. And again, as my colleagues have said, I think a thanks to Chandra and the team for organizing all of this and organizing it so effectively and efficiently. Let me take this from two perspectives, two areas. The first is how we think about working with clients, and the second is just the need for financial innovation. Before doing that, again, let me come back and just set a context. We set out an ambition 2 years ago to provide sustainable financing and investment of up to $1 trillion US. This is just HSBC by 2030. As of June 23, as of last month, we've already committed and invested $255 billion US in this process. So small in the numbers that Mark gave earlier, but I think indication of how serious and how committed certainly one global bank is. I mean, I think the biggest impact when we come back to our customers, and I have one sitting next to me on my left, so I think it's very appropriate. But I think what is most important is we can be most effective by helping our customers through a transition journey. We shouldn't try to avoid that, and I think just given the mix of portfolio we have, particularly across the oil and gas side, both in sector and in geography, Asia and in the Middle East, again, we probably have one of the greatest exposures to this, but also one of the greatest opportunities. I think when we're not in a situation, we've committed to our customers, we can't walk away from our customers, we can't leave effectively people looking for shadow banking, the shadow finance sector to be able to provide this. We have to step up and take accountability and responsibility. And that means working closely with our customers, thinking of looking at their business plans, looking at what they want to do in the future, looking at how they are going to transition and working with them very closely to the process. That is how we can be most powerful in ensuring this is done. There are majority of customers are willing and have accepted and are excited about the journey, and certainly BP is high on that list. Many others, I think we still are encouraging through the process and the journey. And again, there will be some that just won't accept this is the journey to go on, and we won't work with them in the future. So I think it's that level of sort of commitment and determination that we have. On the need for financial innovation, I mean, there's a huge amount of creative thinking going into crowding in finance, sustainable finance through innovative products and systems. Again, a huge amount going on. I think as Mark and Uday have said, I think utilising government support and development bank support to particularly de-risk the opening stages of projects is critical. And we've worked two major projects, one with the Asian Development Bank and the Energy Transition Mechanism, really just to speed up the basis of coal-fired power stations while also investing in green finance. And we've, working across our portfolios, Indonesia has been one of the key areas of focus here. We've also been working on the Just Energy Transition Partnership, which again is helping move some of the emerging markets from coal production to out of coal production effectively. And here we've been working with Vietnam, with Indonesia, and with South Africa. So again, that's sort of the old economy. On the new economy, there's got to be significant finance put into sustainable aviation, shipping fuel, green hydrogen. All of these different elements have different technical aspects, different business plans, and we've got to be able to adapt our business to be able to work with these models of the future. But I think hopefully that gives you some sense of how significant and seriously we're taking this.
That's so interesting and so important, particularly that idea that you need to work with your clients. Just like we need to have energy, we need to have steel. And somehow, part of this $7.5 trillion, it can't be good money is over here. You're the virtuous investors here, and you're the diabolical investors if you're someplace else. And so, and Bernard, you're really at the receiving end of that. We know what you're doing for the transition. HSBC knows. Anyone involved with you knows the sincerity of it. But how would you talk to those people who say, we have $7.5 trillion for windmills and electric cars, and we're not going to give you any of that money? What is the role of oil and gas? And maybe you have a view on steel as well.
Great. Well, I'll stick to what I know a little bit at least. But I mean, how would I make that argument? I mean, I'd quote Mark Carney, if that's okay. And Mark, I learned a lot from him. But one of the things that I learned that he said very, very early on, which speaks to what Mark Tucker just said, which is if we're going to solve climate, We have to go where the emissions are. Everybody's trying to run away from the emissions. Everybody wants to, as you say, build a solar plant or a wind plant or whatever. And that's great, and we need that. But let me tell you, that is not going to help the world get to net zero in the way that we need to. We are not going to decarbonize hard-to-abate sectors like shipping, like steel, like cement, like aviation with a solar farm. We need to actually go to those industries and work with them. We have to go to where the emissions are and work with those industries. Mark coming and working with BP, knowing that we have an objective and an ambition to transition, but knowing that we're an oil and gas company predominantly today. But that takes courage in today's world. But that's the courage that we need, because we simply are not going to solve this problem by simply trying to build just solar or wind plants. And by the way, we're doing that at BP. But we have to work with the hard-to-abate sectors, and in some people's language, that means we have to get our hands dirty and actually work with these industries and help them decarbonize. So that's the first thing that I would say. And secondly, around the role of oil and gas companies, you know, the best way, Lynn, maybe is through an example. If you and I wanted to start up a company tomorrow to supply sustainable aviation fuel that Mark the only way we're going to have any impact on aviation in the next 10, 20 years is through sustainable aviation fuel. Let's say you and I want to start a company to do that. We're going to have to do three things. Number one, we're going to have to source feedstock. Number two, we're going to have to build a plant. And number three, we're going to have to sell it. Now, here at BP, which many people would say is an oil and gas company, what would they have as a role in this new world? Let us just assess how we would do that. Feedstock, the hardest thing you and I would have to do. I am fortunate. Our company has been one of the largest commodity traders in the world for many, many decades. We've just done a deal with a company called New Seed. They grow a crop called Carinata. It's a non-food crop. It's a cover crop. We've done a 10-year supply deal with that. That would be very hard for Lynn and I to do as a startup. We've done that. Secondly, we have to build a plant. Well, guess what? We spent decades building plants. We brought on 34 projects over the last 7 or 8 years around the world. And not alone have we a track record in doing that, we'll build it next to our refinery at BP. And the utilities are there and the power is there, so BP will build it probably 30% cheaper than Lynn or I can as a startup. And then the final thing is we have to sell that product. And Lynn and I will go on Google looking for the chief executive of Air India. I'm sure Chandra would point us in the right direction. But at BP, we have Air BP. We're in 700 airports worldwide. We're in 60 countries worldwide. We have decade-long relationships with every aviation carrier in the world. You look at that ecosystem and you say, why wouldn't we be doing sustainable aviation fuel? We're the natural person to do it. If we want to start up an EV charging infrastructure company tomorrow, the biggest issue we will have is access to land. 550 million people live within 20 minutes of a BP site. Why wouldn't we use that enormous incumbent advantage to take on the transition? So we see the transition as a massive opportunity for our company, not a threat to our business. We see it as a massive growth opportunity. But the reality is we have to do what Mark Carney said. We have to go where the emissions are. We have to work with energy-intensive sectors and help them on their very challenging and difficult, worthwhile though, journey to decarbonize. That's what we're trying to do. We spent 3% of our capital outside of oil and gas in 2019. 3 years later, that number is 30%, and we're on our way to 40% and 50% of our capital going into the transition by the end of the decade. But we can't do it alone. We need Mark Tucker helping us with financing, which he is doing. He's got his constituents. We have to help him make sure that he understands what we're trying to do. It's challenging, it's worthwhile, and it's full of opportunity.
Good job. So that takes me to Mark Carney and Verena to tell us, are you willing to go into the problem? Should governments be in the problem more than they are? And should the private money come in to support these colossal private efforts? And later this afternoon, we're going to be talking, by the way, about how you measure what Bernard is promising to do in the transition, which is a sidebar to this financing question, but it's important.
I mean, the short answer, I wouldn't put it in the future. We are doing that. That's exactly what we're doing. I referenced something Brookfield's doing, this $15 billion fund. That fund takes out the emissions of New York City, London, and Toronto combined. Okay? 15 billion deployed in 1 year. And the reason it does is, yes, there is greenfield renewable, but it goes to where the emissions are, and I'll credit you with that. And for example, buying the largest utility in Australia, which has thermal generation, 7% of Australia's emissions, this one company. We're buying it with partners. It is subject to regulatory approval. And instead of taking a dividend, it's been paying out most of its cash flow as a dividend. All of that money is being reinvested in building 14 gigawatts of renewable and storage. And as that is built, then shutting down the thermal activity. So it's going where the emissions are. It's taking that exposure to the emissions, but with a plan in order to do it. And in answer to your question, is it the private sector and government? It's both. And what is critical, and I'll credit Mark Tucker here, they're standing up and they're doing this, is that the banks, the investors, and others can take exposure to those emissions. In fact, one of the best strategies for the planet is for your emissions in your portfolio to go up because you've run towards the problem and then you're helping to get them down. And what's needed for that is to have some guardrails around and transparency about what you're actually doing. And last point, if I may, it's particularly critical in the emerging and developing world because the pathways, I mean, let's take India. Emissions in India. India is doing a phenomenal job with the transition and it's accelerating. But because of the growth and the surge of the middle class, of course, emissions are going to go up in India for a period. So the pathway in India is very different than what the pathway has to be in Canada. But we want international investors, and this is what GFANZ is working to do, to have greater and greater exposure to India to make sure that that trajectory happens. And that's why you need something called transition finance. Those definitions have been agreed. They're being developed. In fact, HSBC co-led the development of that. So the answer is yes, and I'm glad we're talking about it explicitly because this is the heart of the issue.
This is the heart of the issue, and we at the Council have worked with Chandra, and the way that he describes it, which I think is really important, is it's not our emissions today. It's not Tata Steel or BP's emissions today. It's what is their direction and what is their velocity and toward change. And how do they compare to others in the sector? And how does the ultimate output of their product actually impact society? So I think that this combination needs to be incorporated in what both government and private financiers say. And before I turn to you, Verena, Narendran, is there something that you want to say on this topic?
Yeah.
How you want to work with your private investors?
Absolutely. So I think to echo what Bernard said about fossil fuels in some sense, steel is the most commonly used metal in the world. 30 times more steel is used than the next most commonly used metal. So you can't do without it, right? And for the transition as well, you need steel, whether to hold the solar panels up or for the windmills or for storage, for pipelines, you need steel. So you need to find a solution. And I think there's no silver bullet. There are a bouquet of solutions, which includes hydrogen, which includes carbon capture and usage, carbon capture and storage, everything, because it's $1 trillion industry. And India alone is going to add about 150 million tons of steel capacity every decade for the next few decades. And we have not even started talking about Africa, which is going to have another 3 billion people being added during the century. So I think you will have these hard-to-abate sectors growing. Cement production is twice the amount of steel production globally. So you will have these hard-to-abate sectors growing. So you need to find solutions which are technical, which don't get solved by just finding another energy source. You need to use different materials. You need to more efficiently use steel and cement. And hence the transition is a multi-decadal kind of transition which needs to happen. Infrastructure needs to be built for that as well.
Perhaps you want to share your experience in the Netherlands with your hydrogen project and the role that the offtake buyer, in that case Ford, meant to your advancing the transition.
Yeah. So in Europe, in Netherlands, the path we are choosing is to move from coal to gas to hydrogen. And that transition is important for Netherlands because we will become one of the biggest consumers of hydrogen in Netherlands. So the hydrogen strategy in Netherlands depends on Tata Steel's transition and usage of hydrogen. So we need to work closely with the government and potential suppliers to make this transition happen. We are lucky that our plant is a coastal plant, so that allows us a lot more flexibility in sourcing a lot of inputs. In UK, it's different. It could be a different approach because UK has a lot of scrap which it exports. So it's about how do you recycle that. In India, the challenge is most of the steel capacity is going to come up in Eastern India, where as of today, there's no gas or hydrogen. So you need to solve that problem before you start transitioning into a greener future. So I think each country will have a solution which will depend on the context in which the steel industry operates in that country.
That's very interesting, that sort of virtuous cycle of the supplier, the buyer, the financier. Okay, Verena, what would you like to share on this topic of the difficult to abate industries? Yes. And are your investors willing to see you invest in, maybe it's not called a sin stock, but to invest in the problem? Let's just call it investing in the problem. Yeah. Are you brave enough to do that?
Yeah, actually...
are your investors willing to go along?
Yeah. So when you asked this question, I thought, great question, because we often talk about, investments into new technology and new infrastructure. But I don't know if people are aware, but Macquarie actually made a commitment to invest and manage all of our portfolio companies in line with net zero by 2040. And what that means is we're working with basically 175 portfolio companies around the world and really working with the underlying management teams to do really basic things like verify emissions, setting reduction targets, and really looking at how do you actually develop and deliver a business plan that's going to set them in that pathway to get to net zero by that time. And when we first started this, I think no one actually knew what a good business plan that would actually deliver on this would look like. And I still think we're on that journey, to be honest. But as of today, having gone through that process, we probably have about 80% of our portfolio's companies in scope with a board-approved net zero planned. And by going through that exercise, I think it's given us a little bit more awareness on what are the low-hanging fruits, like what are the action items that we can actually take to reduce emissions as well as costs. So if I can give an example, even with the roads that we have invested here in India, we've started to introduce more energy efficient lighting. We're using more renewable energy sources. Their business plan actually assumes increased uses of biodiesel as well as electrical vehicles. So, that's quite encouraging. And then I think similarly what we are seeing is the use of, green power purchasing agreements, more energy efficiency, and the spike of electric vehicles should reduce Scope 1 and 2 emissions on a chemical storage facility by 42% by 2030. The other example I can give is, we've got a data center. It's an APAC data center, and they're actually a bit more ambitious than some of our other portfolio companies because they've actually recognized the commercial opportunity with this. And that's pretty much being led by our largest customers, who are global technology companies, who obviously have their own public targets, but also, leading in terms of renewable energy procurement. So these are just, very simple examples, but I think, the point about going into where the problem is, that's certainly something we are positive about, because in order for everyone to get to net zero, we can't just think about the new stuff, but we have to really support the existing infrastructure that are on this journey as well.
Thank you. And once again, in every climate debate, we always get down to the emissions issue. But we started with Pope Francis and the cry of the earth and the cry of the poor. Uday, I'd like to turn to you to ask how you evaluate companies in the transition with respect to their workers, with respect to their consumers, with respect to their communities? Do you take that into account? And Mark, I'll have the same question for you, and I think you're going to have the final word.
I think
Mark,
it's...
Mark Tucker.
Sorry. So I do believe that there is a significant challenge and risk of displacement happening as a part of this transition. And there's a set of things which companies can do, which financiers can do in terms of being ready to smoothen the transition in terms of the quantum and the period on which you increase your financing in terms of the number of years and duration versus what you would do so that you ease the short-term cash flows of companies, particularly in the small and medium industries sector where a lot of the pain will last. I think finally, if there is a challenge of this scale, we have to think about what are the long-term strategic and structural solutions which governments can take. Because displacement out of jobs coming, whether it's because of climate change or even technology, are going to be the reality in front of us. And there has been a debate where many countries, and I don't think, again, the business model of governments enables them to afford this, is how do you ensure principles like universal basic income or things like that, which may be the need for the future, how are they going to be embedded in this race for survival of the planet? And I also want to take one point from what Narendran said about solutions at times are more challenging. What we have to be careful in trying to get climate change solutions is that the solution is not worse than the problem. And I'll give back an example of history when the automobile was first invented in late 19th century, early 20th century. Automobile was an answer to the problem of horse manure, as more and more horses sort of invaded planet Earth, especially cities. So horse manure was a major pollution problem for many, many cities. And when the automobile was first invented, it was supposed to be an anti-pollution device, anti-pollution against horse manure. And 100 years later, it's one of the main, or 120 years later, is one of the main causes of problems of pollution. Therefore, as we go for solutions to the problem, let's make sure that the solution actually solves the problem and over time doesn't make it worse. Thank you.
Lynn, thank
In
you.
1 minute. And
Not much more can be said. I think there is clearly a strong agreement through everybody and strong alignment through everybody. I think just one factor perhaps at the end is just thinking about the government role or some level of mandatory involvement. And we've seen a very good example in the UK where through a process the UK government came to many of us to look at what jet fuel, what proportion of jet fuel should come from sustainable sources. And they've come up with a number of around 10%. And I think these elements force you along a journey which I think is encouraging. It may be hard, it may be tough, but I think the role of government also shouldn't be forgotten in this.
right. Thank you so much to this amazing group of people on this panel and for the commitment all of you have to making the green transition. I hope we've explored some of the complicated issues around solving this problem. And, and I'm reminded we're doing this for the same reason that President Kennedy said we should try to go to the moon, which is we do it not because it's easy, but because it's hard. So I hope all of you enjoy the rest of the day, and thank you for your time.
Thank you very much, Lynn Rothschild, for ably moderating that session. That is...